They had already been paid off for 3 years when the transmission failed without warning. It sat in the driveway of a quiet subdivision outside Columbus. The hood closed, the body still clean, the registration current. Nothing about it looked unstable. The household it belonged to did not look unstable either. Two incomes, one mortgage, two children in elementary school, health insurance through an employer with a recognizable name, retirement contributions set to automatic, a modest emergency fund, property taxes paid on time, credit score comfortably above average. Stability had been constructed carefully over 15 years. The first job out of college paid $48,000. By 35, income had climbed to $92,000. His wife's salary started lower, but eventually reached $68,000. Together, they crossed into six figures and stayed there. They bought their home at what felt like the responsible moment. After promotions, after the second child was born, after the student loans were refinanced. The house was not extravagant. Four bedrooms, a two-car garage, a backyard large enough for a swing set, and later a trampoline. The mortgage payment fit inside the recommended percentage of gross income. Property taxes rose slowly but predictably. Home insurance adjusted annually, always slightly upward, never dramatically. Nothing about the numbers ever triggered alarm. But the second car sat motionless in the driveway because the repair estimate came in at $6,400. It was not that the money didn't exist. It was that the money had already been assigned elsewhere. There were 401k contributions that felt untouchable. College savings accounts that had been marketed as responsible foresight. A kitchen remodel financed 5 years earlier on a low interest loan that still had 36 months remaining. A home equity line that had been opened as a precaution and then quietly used for new windows and HVAC replacement. The monthly budget functioned like a well rehearsed script: mortgage, utilities, insurance premiums, after school programs, streaming subscriptions, groceries that had become noticeably more expensive but still manageable, two car insurance policies, gas, medical copays, seasonal expenses that arrived reliably every year. Every line item looked ordinary in isolation. Together, they absorbed nearly all available liquidity. The emergency fund had once held 6 months of expenses. Over time, it became three, then 2.5. A roof repair reduced it further. A deductible after a minor car accident trimmed it again. It was never empty. It simply never fully recovered. The family's net worth had technically increased every year. The house appreciated. Retirement balances grew with the market. Promotions added incremental raises. Bonuses were used to cover irregular expenses. On paper, progress was visible. In practice, flexibility narrowed. They had chosen stability early. Stable jobs with stable companies, a fixed rate mortgage, consistent childcare, reliable vehicles, health insurance plans with predictable premiums. The choices were deliberate. The choices were responsible. They also locked in a cost structure that expanded with every upgrade. When income rose, lifestyle expanded cautiously but consistently. A safer neighborhood, a better school district, a second vehicle to reduce commuting strain, summer camps instead of informal childcare, a cleaning service twice a month when work schedules became heavier. None of it felt indulgent. Each addition reduced friction. Each expense improved quality of life in small, measurable ways. Over time, the baseline shifted. The cost of simply maintaining the existing life, without improvement, without expansion, began to mirror the cost of advancement. Holding steady required as much financial output as growth once had. The realization did not arrive dramatically. It appeared in the form of small hesitations. A conversation about whether to repair the car or replace it. A pause before booking a family vacation that will be paid with a bonus not yet received. A quiet awareness that a job change would disrupt not only income, but health insurance deductibles already met for the year. Stability began to feel conditional. The husband received a recruitment message from another firm offering a higher base salary but less predictable bonuses. It required relocation. The offer looked attractive in isolation, but moving would mean selling the house, entering a higher interest rate environment, resetting property taxes, and absorbing closing costs. The children would change schools. The existing pediatric network would dissolve. Retirement contributions would pause during transition. The household did not decline the offer because it was risky. They declined because their current stability had become expensive to interrupt. The mortgage rate they secured years earlier was lower than anything available now. Refinancing had once been an advantage. Now, it was impossible without increasing monthly payments. The house appreciated, but accessing that appreciation required borrowing at higher rates. Homeownership had created wealth. It had also created inertia. The couple's careers plateaued slightly in their early 40s. Raises became smaller. Promotions became competitive. Healthcare premiums increased faster than salary adjustments. Property taxes adjusted to new neighborhood valuations. Car insurance rose after regional rate changes. None of the increases were dramatic alone. Collectively, they outpaced income growth. The children aged into more expensive phases. Travel sports replaced local leagues. School fundraisers grew more ambitious. Technology became necessary for homework. Social expectations shifted subtly but persistently. Maintaining perceived stability required keeping pace. The kitchen remodel from years earlier still looked modern, but the loan payment remained. The home equity line's variable rate adjusted upward twice in 1 year. The HVAC system, replaced preemptively to avoid emergency failure, came with financing terms that blended invisibly into the monthly obligations. Nothing felt reckless. The household avoided credit card balances. They tracked spending. They compared insurance rates annually. They contributed to retirement accounts consistently. But the structure they built assumed continued stability in income and health. When his company announced restructuring, no immediate layoffs occurred. Departments were consolidated, titles shifted, responsibilities expanded without proportional pay increases. The job remained, the salary remained, the sense of control diminished. He began to notice how much of their identity was tied to appearing stable. The maintained loan, the reliable vehicles, the ability to say yes to school trips without hesitation, the retirement account statements that signaled forward motion. Pulling back anywhere would be visible, not publicly catastrophic, just noticeable. Selling the second car and reducing to one vehicle would complicate commuting. Canceling summer camps would create childcare gaps. Downsizing the home would mean explaining why. Perceived stability carried social weight. The couple's friends lived similarly. Comparable homes, similar incomes, similar obligations. Conversations revolved around interest rates, property values, travel plans, college tours. No one appeared unstable. Yet, private conversations occasionally revealed strain. A medical bill that exceeded expectations. A bonus that did not materialize. Parents aging and requiring financial assistance. The margins were thinner than appearances suggested. The transmission replacement was approved. The repair was charged to a credit card offering promotional financing. It would be paid off within the promotional window. The emergency fund would remain intact for now. It was a rational decision. It also illustrated how even manageable disruptions required structured responses. Years earlier, a $6,400 repair would have been inconvenient but straightforward. Now it intersected with multiple financial commitments calibrated precisely to income levels. Their retirement accounts continued to grow. Market returns fluctuated but trended upward over time. Statements projected comfortable retirement ages. College savings accumulated gradually. The long term trajectory appeared intact. Short term elasticity declined. Vacations shortened. Dining out became less frequent. Subscriptions were reviewed. Minor lifestyle trims occurred quietly, not as declarations, but as adjustments. No dramatic cutbacks, no financial crisis, just a slow recalibration. The husband began to calculate fixed expenses reflexively: mortgage, taxes, insurance, utilities, debt payments, baseline groceries. The number was substantial. It represented the monthly cost of maintaining their existing life without discretionary additions. He compared it to net income after taxes and deductions. The gap was narrower than he remembered. Stability required consistent performance at work, consistent health, no prolonged interruptions, no major unplanned expenses beyond what insurance covered. The household was not fragile, but it was tightly balanced. In their late 40s, conversations about aging parents became more concrete. Assisted living costs surfaced. Medical support extended beyond insurance coverage. Siblings contributed unevenly. Financial assistance flowed quietly outward from their household. It did not collapse their budget. It reduced optionality further. The idea of taking a sabbatical disappeared. The possibility of one parent stepping back from full time work faded. The children's college years approached with projected tuition figures that exceeded early estimates. The couple had done everything conventionally correct: education, employment, homeownership, savings, insurance, upgrades timed to income growth, avoidance of visible excess. The life they built was stable. It was also expensive to maintain. Selling the house would generate equity, but buying again would reintroduce higher borrowing costs. Renting comparable space would not be cheaper in their area. Moving to a lower cost region would disrupt professional networks and family proximity. Geography itself became part of the cost structure. Their net worth crossed a milestone that would have seemed unimaginable in their 20s. On paper, they were wealthier than ever. Liquidity remained measured. Retirement funds were inaccessible without penalty. Home equity required borrowing. College accounts were earmarked. The emergency fund hovered at a disciplined but finite level. The visible indicators of stability, house, cars, education, career titles, obscured the internal rigidity of the system. In their early 50s, healthcare premiums increased again. Deductibles rose. One minor outpatient procedure produced a bill that insurance partially covered but did not eliminate. The amount was manageable. It joined the ongoing stream of predictable unpredictability. The second car lasted several more years after the transmission replacement. Eventually, it was traded in, replaced with another reliable but financed vehicle. Interest rates were higher now. The monthly payment returned. They no longer discussed whether two cars were necessary. They assumed it. The children left for college. Tuition payments began in earnest. College savings covered a portion. The remainder required structured withdrawals and minor loans. The house grew quieter, but not less expensive. Utilities declined slightly. Insurance remained. Property taxes increased again following reassessment. Stability did not shrink when the household size shrank. It maintained itself. The husband occasionally thought about the early years of marriage when their apartment was smaller, their obligations fewer, their expenses lighter. Income was lower then. So were expectations. They did not feel unstable then. They felt transitional. Now they felt established. Establishment required funding. Retirement approached gradually. Projections were recalculated annually. They were not behind. They were not significantly ahead. They were aligned with common benchmarks. The realization surfaced not as regret, but as recognition. Maintaining perceived stability over decades had consumed nearly all surplus energy and income. Every raise had been absorbed. Every improvement had become baseline. Every safeguard had ongoing cost. Nothing had collapsed. Nothing had dramatically accelerated. The life they built remained intact. The driveway held two functioning cars again. The house exterior was maintained. The retirement accounts continued their steady growth. Health insurance premiums were paid. Property taxes were current. From the street, nothing appeared strained. Inside the monthly ledger, stability had become its own permanent expense.